Hello and welcome to Wrestling with Real Estate, where we look to chokeslam all your real estate problems. I'm your host, former WWE wrestler and now Circus Soleil performer, and of course, multifamily real estate investor, Barri Griffiths. Now today we're joined again by Michael Becker. Hey, Michael.
Hey, Barry.
Welcome back for part two. Part one was absolutely fantastic. So anyone who hasn't listened to that, please go back and listen to that because there was so much great information shared in there, so many great nuggets. Please go back and listen to that. You won't regret it. But in this second part, we're going to dive into the lending environment and what is the lending environment? Say, what does that look like? What kind of loans people are doing? What people should be aware of. But before we do that, if you want to give people just a very quick high level, in case they haven't listened to the first part, about you and what you've been up to.
Based in Dallas, Texas, run a company called SPI Advisory. So we're a multifamily investment firm. We have about 7,000 units or so right now in the portfolio. We've done nearly 12,000 in our career. So we sold, I guess, about 5,000, give or take, and focus on Dallas, Fort Worth, Austin, San Antonio. Those are our major markets. And as we talked about in the last show, I'm the co-host of the Old Capital Real Estate Investing podcast. So you can find that on iTunes or Stitcher, or probably anywhere you hear my voice. And that's if you're an apartment nerd and you like to learn about that, that's maybe the podcast for you.
It's definitely the podcast for you. You should definitely check it out. There's so much great information shared on that show. And you also used to be a lender, so you're the perfect person. And you
Yep.
obviously you're doing a lot of deals right now. So what does in what are we, July 14th, as we're recording this, 2021, what does the lending environment look in the apartment space right now?
Man, it's very robust, diverse, lots of liquidity, lots of lenders not looking for to get their money out. So it's about as full, open, and robust as I've ever seen in my entire career. So it's a great time to be a multifamily borrower right now.
So let's talk about you and specifically in the type of deals you're doing. What kind of financing are you getting, or does it vary? Does it vary greatly from deal to deal, or do you have sort of a template of what you use?
Yeah, every deal stands on its own, so kind of depending on what it is. But we've done anywhere from some of the debt funds recently, which is not my preferred route, to bank loans, to a lot of agency loans. So Fannie Mae, Freddie Mac. We've had a HUD loan. We've had life insurance company loans. So I've done pretty much most of the major categories within the multifamily lending space. But the typical deal that we've done a lot of over the last couple of years is a Freddie Mac adjustable rate mortgage. So we're typically doing a 10-year floating rate mortgage with 5 years of interest only. That's a pretty typical deal that we've done a whole lot of here. So that's probably my most favorite execution if we can find a deal that makes sense for that type of loan.
Yeah, and just hearing from that, the floating rate means that it changes according to where interest rates are, right, in the market currently. How often does it change? Like, can you explain a little bit more about it?
Sure.
Why would you go for a floating rate? Most people would be like, well, fixed rate is the way to go, right? You know what you're paying and whatnot. But can you maybe explain?
So when we started out, we did a lot of Fannie Mae fixed rate mortgages. That was probably the first 2, 3 years, 4 years of my career. That was almost exclusively what we did. And if you go back, I started in 2013. We bought our first deal, so 8 years ago. And it was a great time. It was what we thought at the time. Rates were really, really low, around 5%. And they started giving out a whole year of interest only. So you could do a 10-year fixed rate mortgage, 5%, get a whole year interest only, and the loan was assumable. And we thought that when we sold it, the rates would be higher and be very accretive to our situation. So what turned out to be reality, where interest rates went, from 5 to lower, and 1 year of interest only went to 3 years of interest only, went to 5 years, 6 years of interest only. And so what we thought would be an asset turned out to be an anchor around our neck, because these fixed rate mortgages come with prepayment penalties, either called defeasance or yield maintenance. So they kind of function a little different, but the results pretty similar, where depending on your rate relative to the current market, if you have a rate on your mortgage which is higher than what the replacement rate is, your prepayment penalty goes up. And the more term you have left to maturity, the higher your prepay is, closer to maturity, the lower it is, like a formula. So we have, that's been the single biggest mistake I made over and over my career. We've eaten tens of millions of dollars in defeasance or yield maintenance prepay penalties over the years that we just basically set on fire. So we learned that lesson really good. So having a little bit more flexible exit, unless you're just 100% guarantee that you want to own that loan, we've been kind of going a little bit more on the adjustable rate mortgages. Now, with that said, I did just actually last week we're refinancing a loan. We did a 5-year fixed rate. We locked it in at 2.12, which is insane. On a 5-year full term IO is a little lower leverage at 60% leverage. And that one felt okay to lock in. And that does have defeasance prepay on it, but that's kind of the exception. We're more in the adjustable rate mortgages because I'm in the camp. I don't think we see a lot of interest rates going up, especially on the short end of the curve for the next, few years at least, is what my crystal ball is telling me at least.
And with the adjustable rate, the defeasance or the prepayment penalty is much less, or is there?
It goes away, right?
Oh,
so either
wow.
It'll be open at par, meaning no prepay, or sometimes there's like a 0.5% to 1% of the loan amount prepayment penalty. Versus we sold a deal about a month ago. We put a 12-year mortgage on it right when the election was going on at the end of 2016. Rates had ticked up, and then they were substantially lower. So it was about a $6.5 million prepay on a 23 million bucks, or what was that loan? Something like that. So it was like 20% prepay, right? So 1% versus 20% of the loan amount was insane. And it still made sense to sell it. We still made a bunch of money, but that tells you how much money we just kind of set on fire if we just would have made a different decision back when we bought it a few years ago. So I'm not necessarily opposed anymore to fixed rate mortgages. I was kind of getting more allergic to defeasance or yield maintenance prepays. That's just been a big problem that not only that we've had to deal with. A lot of people, they think, you get in these apartments and, especially when you're younger in your career, you think you're going to own this 50 unit deal forever. And what happens is, you kind of own apartments in dog years, right? Every year feels like 7 in reality. So when you get going, especially smaller deals, you either one or two things are going to happen. You're going to get in it. You love this business. You can't wait to sell it and trade up and buy something bigger, or you hate this business and you can't wait to sell it and never do it again. But usually you're trading up, and then kind of these smaller properties aren't very efficient. You want to buy bigger and scale up. So, having a little bit more flexibility. So if you do want to take a fixed rate mortgage, maybe take a 7-year mortgage instead of a 10-year mortgage, because that will limit your exposure on the prepay if you do change your mind and you want to sell it. So that might be a lesson I learned the hard way. Maybe someone can take away from this conversation.
Yeah, and a lot of times it's about lining up your business plan with your term as well, right? If you think you'll be out in 3 years, you maybe want to get a 5-year loan for, rather than a 12-year, right? At that point, if you think that you'll be out, so you match your business plan to your loan as well. Something I heard you guys talk about on the Old Capital show is that bridge financing is really becoming more and more prevalent right now. Do you want to speak maybe to people who don't know necessarily what bridge financing is, and then why that's becoming so popular?
Yeah, so there's both bank loans are pretty abundant right now, as well as there's like debt funds, what we call them. So basically, they raise capital and go put it out. Basically, they'll borrow money at 1 or 2%, loan it out at 3 or 4%, and kind of make a spread. And so those loans are getting aggressive. I mean, the most aggressive ones you get 80-85% leverage. In the kind of the 4% give or take range, maybe 4.5 if it's a little higher leveraged, and you do that with just without recourse. So just the bad boy carve outs, not personal guarantees on loan, and or you could take maybe a little bit lower leverage and get into kind of the low to mid 3s on some of that. Or you can sign a guarantee and get cheaper on that if you go with the bank loan, a signed guarantee or a partial guarantee. So they're very abundant. And so if you're looking to maximize your loan proceeds and minimize the amount of equity you have in a deal, to really kind of drive your pro forma returns, getting these debt funds, you lever up and get 80-85%. It makes these deals look really good on paper if everything goes well, but obviously it amplifies the risk. And if you mess up, then and you have a lot more likelihood of getting yourself in some trouble if the market softens or you go over your budget and a lot of those terms are a little bit more onerous, and some of these debt funds can be kind of in the loan to own business. So you got to be a little careful because they can be a little predatory in some of their business practices. So making sure you understand what you're getting yourself into, and some of the covenants and restrictions they put upon you can be a little onerous. So everything's not created equal. So making sure you kind of understand and have a professional help you through that process if you're inexperienced, because there could be some gotchas in there that you don't really realize in those loan documents. So we've only done one debt fund, and it was a real pain. And I don't really plan on going back if I can avoid it, but never say never. But it's a tool in the toolbox, and it's working right now. And that's part of what's driving this pricing up in today's environment, is people able to really push the leverage, to push their pro forma returns, to pay a little bit more for that property than what they could have a year ago, let's say.
Yeah, and I didn't realize, like you said, a lot of these debt funds, the people that do this bridge financing, they're actually owners themselves, right? They're looking to actually, ideally, for you to default, for them to take over the property,
Yep.
pennies on the dollar. So it's like you said, it's a little predatory. So you just need to be, people need to be aware of that. And then, like you also pointed out, I guess with them underwriting on the pro forma, they're not using actual T12 numbers. They're just using numbers, and so you're able to buy for a lot more than you would if you're using traditional underwriting, right? Is that the
like
case?
that's a good point. Like Fannie Mae and Freddie Mac are going to underwrite on historical collection numbers. So they're going to look at like the T3 typically, so your last 3 months worth of collections on your income, and then they're going to look at your underwritten expenses. So they're going to adjust your taxes up and make sure your insurance is right and your repairs and maintenance are right, and they're going to lean on the appraiser and get the kind of pro forma expenses, but historical collections. Or if you go to like a debt fund, they'll budget kind of future collections, and they're not really caring as much about what current collections are. They're more looking at, say, what's year 3 collections projected to be, and they're going to kind of underwrite and size off of that, more so than what historical numbers are. So it just adds a little element of risk. So there's a time and place for it. It just just want to be careful that you understand what you're getting yourself into, because it could end in tears if you don't understand what you're getting yourself into.
Yeah, absolutely. So looking forward now, where do you think financing is going to go from here? Do you if you had a crystal ball and you were looking into it, where do you think financing is going to go from here?
I mean, so if you were to, go back to the beginning of 2020, I mean, the capital markets were robust, fully on, and then, mid-March just completely shut off, and then kind of slowly turned on third quarter, a little bit more fourth quarter of 2020, and then kind of getting into 2021. All these lenders realized they had all these loans that they were supposed to get out last year. They didn't. So then they're starting to try to throw the money out there. And so it's just been ever escalating. So I think we're going to be in an environment for the next several years with a very full and robust menu of options, and the debt markets. I think interest rates are likely to stay kind of in the similar ranges to where we are here, kind of, mid-year 2021 as we record it. I think the rates will stay relatively in this same kind of range, maybe go up and down a little bit, but I don't think we go super wide and see rates really run anytime in the near to intermediate term, next 1 to 3 years. I think we're kind of in this basic environment. So I think it's going to continue to fuel this pricing going up. And then operationally we're seeing every time I think the market can't get hotter, Barry, it gets a little bit hotter. I mean, in real time, we finished the second quarter. We're in kind of the beginning of the third quarter of 2021. I mean, we're seeing double-digit rent growth across the entire country. I mean, with 1 or 2 exceptions, with so I think maybe New York and San Francisco and markets like that are struggling. But I mean, irrespective of the property type and location, they're pretty much the nation's averaging double-digit rent growth, which is unheard of. And so we have some assets in the 20s right now in real time. So the old leases to the new leases getting $300-$400 higher rents. And when it's not like we're renovating all these properties, it's just kind of organic rent growth. And some of that's having a little depressed base from a year ago when we signed the old lease to a better market today. But I mean, that's we're basically seeing 3 to 4 years of rent growth in 3 to 4 months, right? I mean, it's insane. So it's certainly not sustainable for any extended period of time, but we're resetting the base to these much higher rental rates. And and it's going to continue to fuel people wanting to come into the market. And it's like buying a growth stock, right? You're willing to pay a higher PE multiple for a growth stock than you are kind of a slow and steady, value stock. And that's what we're seeing a lot right now. So these cap rates are getting lower, the debt's fueling it. We're seeing rental rate growth. So I think we're seeing it's the golden age, man. It can't be better than it's been right now. And I think we got a couple of years of some pretty tremendous growth ahead of us.
That's good. I was going to ask you about the crystal ball in terms of apartment complexes, but you covered it there. So it's bullish, right? And get in and do the right things, but it's definitely a great space to be investing in.
Oh yeah, the winds that are back, and especially if you're in the right markets and you have the right property. If you buy the right property in the right market and get the right management team to run it for you, you should do phenomenal. I think if you just get the market right and not totally screw it up, you'll still probably do pretty good, right? I mean, so like you can make it great, but I think the market is going to be so strong, it's probably going to cover up a lot of sins, which it has been doing for the better part of the last decade. So even the people have made some mistakes, they still make a lot of money. Like I told you with the prepayment penalties we had, we still made a ton of money in spite of making that mistake.
Very cool, very cool. Well, this has been a fantastic second part as well. So there's, again, if you haven't listened to the first part, go back to the first part. And if you have, listened to the second part again, because again, there was so much great information that you can learn so much through that. So Michael, thank you so much for being on the show. I really, really appreciate this. I know you're exceptionally busy, but I thank you so much for being on the show and sharing all that. But before we go, if people want to reach out, get in touch with you, want to find out more about what you got going on, how can they do so?
Yeah, I'll give you two resources. Again, the podcast I host is the Old Capital Real Estate Investing Podcast. Find that on iTunes or Spotify, or probably anywhere hearing my voice today. You can find it there. Our website's just the oldcapitalpodcast.com. Or the other way you can find out about me, the company I run is a company called SPI Advisory. If you want to get some information about potentially investing with us, simply go to a website, which is www.spiadvisory.com. It's SPI like spy advisory.com. Just contact us form, fill that out. We'll always have to get you in the database and send you information about what we do.
Very cool, very cool. Well, thank you so much. Have an awesome rest of your day there, man.
Thanks, Barry.